This session to take a seat, and we'll kick off in just a moment. Okay. I'll just check the AV guy. We're ready to roll. Okay, so we will get started now. So welcome everybody, and thank you very much for coming to join us this morning here at the Australia Pavilion for the launch here at COP of the NGFS Conceptual Note on Adaptation. I'm Carmody, I'm from the Australian Prudential Regulation Authority, and I'm actually here in my capacity as co-chair of the NGFS Adaptation Task Force. Now the NGFS, it's the Network for Greening the Financial System. It's an alliance of now 141 central banks and financial supervisors, all focused on sharing best practice and responding to risks associated with climate change and thinking through how they affect financial institutions and financial stability, but also in support of the mobilisation of sustainable finance. Now, up until fairly recently, much of the work of the NGFS on sustainable finance had been focused on mitigation. But increasingly, it's evident that there is a real need to respond in the form of adaptation. Even if we're able to achieve all the goals set out through our respective NDCs, there's a certain amount of climate change that's already baked in, and we are starting to see the effects of that change in various ways around the world, which just highlights how pressing the need for an adaptation response is. So it's not an either or, it's a both and. And to that end, the NGFS established earlier this year in May a task force to really look at the question of adaptation finance gaps and what the implications are for central banks and financial supervisors in the area of financial stability, and also to try and map the way for some further work in that area. Now, we've just published our first note, which is an exploratory note really mapping out the landscape of this topic. I will jump to this slide. So it's live on the website. That QR code will get you to the note, which you'll be able to download. So I will invite you to read that at your leisure. Shortly, I'll be joining a panel, and I'll introduce the panelists to discuss the topic of adaptation finance. But before that, I would like to acknowledge my co-chair on the task force, Shelagh Kahonda from the National Bank of Rwanda. Now, unfortunately, Shelagh was not able to join us here in person at Baku, but she was able to record some brief introductory remarks, and so I'll play those before we move to the panel.
Warm greetings from the land of 1,000 hills. It is an honor for me to address you as we launch the NGFS Adaptation Concept Note and continue on our journey of raising awareness on the risks that the financial sector and its regulators face from a failure to adapt to a changing climate. The concept note we've launched is a blueprint on how financial systems can rise to the pressing demands of climate adaptation. The purpose of this publication is to make known the importance of considering adaptation to climate change for central banks and supervisors within the context of their core mandates of price and financial stability. This note explores the relevance and importance of adaptation to both chronic and acute effects of climate change for central banks and supervisors, given the breadth of interpretations, varying definitions, differing areas of influence of central banks and supervisors, and differing national circumstances. It complements the NGFS core work of supporting its members in assessing the microeconomic and financial stability implications of climate change and adjusting their policy actions accordingly. As we advance, it's essential that adaptation considerations are embedded within risk management and policy frameworks across the financial system. I invite all regulators, policymakers, industry leaders, and all other stakeholders to explore this concept note with an intention of identifying an area of potential interest. This could be in improving metrics and tools to measure adaptation and its impacts on the economy and financial system, It could be exploring the need for supervisory or regulatory framework enhancements. It could be fostering an enabling environment for adaptation finance, or it could be collaboration at the international level with actions focused on local considerations. Resilience in our financial systems must be as adaptable as the ecosystems we strive to protect. Climate adaptation isn't just an environmental imperative. It is an economic foundation for a future where both nature and markets must thrive. I would like to express my deepest gratitude to all the members involved in developing this publication, the Secretariat, and my co-chair, Sean, and our teams. Because of your expertise and commitment, we have a foundational piece on climate adaptation for the financial system. In the words of the renowned evolutionary theorist, Charles Darwin, it is not the strongest of the species that survive, nor the most intelligent, but the one most responsive to change. Thank you. Warm greeting.
Okay, well, I will now invite my fellow panelists to the stage. So we have Eric Usher from the UN Environment Programme, the Finance Initiative. We have Irene Heemskerk from the European Central Bank, and she's the head of the Climate Change Centre at the ECB. We have Jill Lofts from EY, and she is the Global Financial Services Sustainable Finance Lead. And Stephane Hallegatte from the World Bank, Senior Climate Change Advisor, will be moderating this panel discussion. So I'll hand over to Stephane. Thank you very much.
Thank you so much, Sean, and thanks very much for offering me the opportunity to moderate. We have a little bit of time, and we have 4 great panelists, so we'll try to be to the point and short, and maybe keep time also for you to just ask questions to our panelists. So just to introduce and how I'm stepping into this panel, there are 2 important conclusions that we had from a study we just published last week on adaptation and resilience. One being that when we look at the preparedness of countries, we see countries do a lot of progress, but the bucket in which they are lagging is the macro-fiscal dimension. And so I was really coming to that panel with a lot of questions about why is that so and what we can do about it. The second conclusion of this book is that even though a lot of people keep repeating that very little is happening on adaptation and resilience, when you start digging, it's quite the opposite that jumps to you, right? You have a lot of action, including in the private sector, but very often it's not labeled adaptation and resilience. It's labeled good business practices. It's labeled increasing revenues and reducing costs. Sometimes it's labeled responsibility and sustainability. So we're missing a lot of the action, and I noted that she was discussing the importance of metrics and measuring adaptation. To us, it's a key question because we don't see what's happening. So it's another of the key things that I hope we can discuss today. So we'll do this in first 2 rounds of interventions. First, we'll try to focus on the needs and the gaps. What do we really need central banks, supervisors to achieve? And the second part will be more focused on the solutions, where I think we want to look at very concrete things that can happen, not in 2050, right, but in the next few years. But so Sean, I'll start with you and how you see those needs and how this concept note, which is the first step in a process, what are the key priorities for the task force, and what do you see are the key needs for central banks and supervisors and building on their mandate, right? So I'm really interested to know more on this.
Thanks, Stephane. So look, I tend to come at this question from the perspective of a prudential regulator, so I think about it in terms of risk and risk management. And the way we outlined it in the concept note is we think of sort of vulnerability to climate change. You can think of as this sort of complex interaction between the hazard, so the physical environment, the change in the climate, exposure, what is the sort of the direct exposure of our built infrastructure, our communities, our systems to to those hazards, and what's the vulnerability. You might be in a relatively high-risk space, but you might have a more resilient building or a less resilient building. So it's the interaction of all of those things. And then that sort of risk perspective is one that, as a prudential regulator, we encourage all of our institutions to think about when they're underwriting, as insurers, when they're lending and so on, thinking those things through. But when you think about risk management, it's not about just assessing the risk, it's also trying to manage that risk and respond to the risk. And obviously, the efforts to address the natural hazard piece, that's the mitigation space, but all the responses where you're trying to either reduce your exposure, which might be about building standards and not, putting new apartment developments in floodplains, that sort of thing, or increasing resilience, so reducing the vulnerability, reducing your vulnerability to that exposure. That's really what we're trying to turn our mind to, and really trying to encourage institutions that we supervise to start thinking about those sorts of things. And I'll give you one little example of how it sort of played through in the Australian context, which is that we've made use of the NGFS scenarios. They've got a suite of half a dozen scenarios that look at possible trajectories for physical and transition risks out to 2050. We did a big exercise a couple of years ago looking at the 5 largest Australian banks under these scenarios. One of the questions they asked us when we gave them these scenarios for what the climate would do, what the economic trajectory would be, is they said, well, when we lend in our mortgage portfolios, we require there to be household insurance in place. What should we be assuming about the availability of home and contents insurance in parts of the country in 10, 20, 30 years' time? And we said, well, that's a very good question. We don't know. So we're actually now doing a very similar exercise with the 5 largest insurers down to the property level to really try and get that insight. So it's really about trying to understand and then respond to the extent of the exposure and the vulnerability to those risks.
Thank you. And I think I'll turn to Irene now. And basically the same question, but adaptation is very local, right? Different countries have different challenges, different needs. How do you see that sitting from the ECB, where you have very different countries and very different contexts?
Thank you. Thanks for being here today. Maybe the local is indeed the point. I think what impressed me most last year, or over the past year, is talking to a gentleman from Samoa. And I asked him, what is your biggest worry about climate change? And he said, well, we're basically looking where we are going to seek asylum with our family. So this is how big the problem is. Bringing it closer to home, we've seen the devastating floods in Valencia. 2% of GDP washed away. That's what the governor of the Bank of Spain said past weekend, already estimated. So there is a big uptick in losses already. And what we've done in Europe, and you see where we also saw the difference, talking about needs, we investigated what is the climate insurance protection gap in Europe. And we looked at the whole of Europe, how well is everyone insured. We found out that only a quarter of properties in Europe are insured or shielded against climate change or natural catastrophes. And in some countries, it is as low as 4%. So that shows also the difference. So in this research we've done, we also proposing a European approach to shield from these kind of risk. And I like what you mentioned, Stephane, at the start on the fiscal capacity, because this is where it sits. If there's a catastrophe, it will finally fall. Well, hopefully there will be insurance, so it can be shielded a little bit. But they'll look at the government. So we need to fund it. And where's this money coming from if you also have to deal with adaptation measures and you have to deal with mitigation measures? So these 3 communicating vessel needs of funding, what is the big topic at COP this year, this is something we really have to tackle. And there to see how Sean referred to, I think, the blended finance aspect already, to see how can you use that better. So that's what I want to bring in on that. And if I may, I want to also flag how adaptation or physical risk relate to 2 other macroeconomic trends, like the demographics. So the population will rise up to 1 billion in 2050. That means that more people will be living on the planet, and they'll be living in areas probably not always so suited to live. So we also need to make sure that like the places where more people need to be protected, or where are they going to live? And the other bit is, of course, the migration that will happen if things are not being adapted. So that it's the other macroeconomic trend that it really relates to. The other one is technology. One way technology can really help us to find better data, to know where we can need adaptation and what we can do about it. But on the other hand, if everybody put an AC on its roof, we'll be adapting, but it will, again, not help us with the whole mitigation effort. So it's a very complicated issue, and I think we really should be looking at it. Where do we see the needs? Where do we need the finance? And what needs to come from governance? What can, like, the private sector, how can we work with blended finance? What can the private sector finance? And also, what can we carry ourselves in the end to incentivize our homes and shield ourselves?
Thank you, and I think you're making my job very easy, because one of the next question I had is we often start from the insurance part, and one of the things that we see, especially when we do country diagnostics, is this part of the equation really depends on what happens on the other side of the equation, which is prevention and adaptation. And so I'd like to turn to you, Eric, because you just published the Adaptation Gap report, where you're looking at the investment needs to prevent those risks and reduce them. So maybe you can summarize a little bit the needs that you see from that angle.
Well, thanks very much. And UNEP's our flagship publication is the Emissions Gap Report, which contributes to the process in terms of reducing emissions. But the sister report, it looks at the adaptation gap. And in terms of some of the needs, they're not surprising around issues of lack of awareness, underfunded, underdeveloped foundational market infrastructure not being there, the challenges around sort of the distributed benefits of adaptation and resilience, uncertainties around pricing, and generally around needs. And I think you've said yourselves in terms of often adaptation is being done, but it's not being tagged as such. So part of it is just an awareness raising and understanding of what needs to be done. At UNEP, for those who don't know, we're a long-standing part of the UN, working under a set of frameworks with different parts of the finance industry. The Principles for Responsible Investment, the first framework launched in 2006. It's Principles for Sustainable Insurance in 2012, and for Responsible Banking in 2019. So specifically looking at the banks we're working with, essentially efforts around identifying and navigating how to respond to physical climate risks. And I think some of the barriers point to the need for central banks to be clearly involved in supporting banks in identifying and gathering data. This is what we've already been hearing. And stress testing exercises and some examples like the UAE, I think the UK and EU to some extent have been starting to move in this direction. Emerging markets, developing countries are particularly vulnerable to climate impacts, and also really have a paucity of good data. So it's quite challenging, and so the NGFS certainly could be key, I think, in supporting technical assistance and financing it to have better open source data in these markets. And central banks and regulators also can play a role in the development of the taxonomies. And certainly developing a taxonomy is only half of the work. Actually deploying it is in many ways more challenging. So we need to figure out, how do you roll it out? How do you deal with the market pressures back and forth? Different taxonomies for different jurisdictions and different issues of concern in different jurisdictions. But those would be sort of pointing to some of the foundational needs we believe that are needed. Within UNEP, our banking work, it started with mitigation, net zero. We host many of the GFANZ alliances. The Net Zero Banking Alliance is by many measures the largest or the most global. We have about 150 member banks accounting for a little bit over 40% of global banking assets, working on trying to drive the frameworks and setting targets and implementing those targets on mitigation. But adaptation has also been very quickly rising. And I would say adaptation finance and nature finance are the two areas where we're seeing the most growth of interest recently. But as we move away from the notion of a price on carbon into more ambiguous terms, banks often have a hard time moving forward, and they're looking for direction essentially to get the methodologies right. And I think the NGFS that you're working is very, very critical to help with this, the signaling, and generally what the central banks are doing through stress tests and otherwise, it helps get banks get their understanding what the requirements are. Even if they're voluntary in terms of first steps, it allows them to start getting their houses in order.
Thank you, and I'll turn to you, Jill, now for maybe the perspective of in the financial sector of all of these banks and investors trying to map this very complicated space at this point. Just tell me what we need.
Thank you. Thank you very much. I've actually got 4 needs, but I'm going to give you 2 as needs and 2 as solutions. So I'm saving the last 2 to later. This week we have been talking about the negotiations of the new collective quantified goal. And within the FS community, I think there has been a lot of focus on, should that be the focus or should it be transformation of the finance system? And so I think really, constantly asking ourselves the question as to how we mobilize private finance at scale, at pace, is really at the tip of my tongue. So 2 points I'm going to raise as needs. The first one is globally aligned, but locally enabled. So clearly, if you're a global financial services firm, the more, to your point, that all of the regulations are different in different jurisdictions, then the more expensive it's going to be for you, the more cumbersome, the more difficult it's going to be to implement. And that's why a lot of the measures that the other panelists have put forward today is great, because the more interoperability and the more alignment globally there is for FS, then that helps them to implement. But locally enabled. So we see local regulations on financial services, I would say unhelpful for not just adaptation finance, but climate finance in general. So I'll give you an example. Is the UK pensions regulation enabling investment in climate finance? The risk profile that the pension funds can take in the UK, is that really helpful in long-term climate finance investment? Question, right? Another example I will give you is regulation on insurance in Brazil, for example. Now, I haven't checked this out, but I'm told that in Brazil, foreign insurance firms need to cooperate with a local partner in order to have a license to operate. Now, if we think about the potential insurance needs of Brazil, they're huge, and they would go, I would suggest, well beyond the scope of the local market. And so I do think, whilst we need the regulation to be globally aligned and the initiatives that we've covered in the panel, we also need, at a country level, for countries to think about how much they are enabling the finance, both internationally and locally. That was one point. I'll be much quicker on my second point, which is really the other thing that financial services need are clear market signals. So I'm talking about all the regulation that's got nothing to do with financial services. And the policy. So NDCs, for example, this year, and we've been talking about bankable and investable NDCs, but what we really mean is, how much can we trust and believe in, and how real are the NDCs? Because clearly that potentially provides a country-level market signal for financial services. But then you've got things like the sectoral plans within countries, the policies within countries. So everything outside of FS that could attract both local mobilising of finance, but also international mobilising of finance.
Thank you. And this really speaks to me, because one of the key challenges that we see now is this trade-off between context specificity, that you really need things adapted to the local markets and the local context, and at the same time, for the global players, especially if it's different in every country, the costs increase so much that you might have, especially small markets being completely left out. So this balance between interoperability and context specificity, I don't think we have really a solution for that. We will turn now to the solutions, and I hope this will be connected to the needs. And just to introduce that, Sean, one of the other key findings that we see on adaptation is how this is connected to development and economic growth in general. That to make people more resilient, we need economic development, we need economic growth. So it's very connected to the basic mandate of central banks and financial regulators. So I was just wondering if you could tell us how you see the role of NGFS in supporting those regulators and central banks, and maybe using the example of Australia of how this is going on in practice.
Thank you, Stephane. And look, I go back to a point you made in your earlier remarks, which is that often when we sort of think about adaptation finance, we're actually not measuring everything. And one of the points we make in the concept note is we sort of say, well, there's kind of quote unquote adaptation finance, which is the sort of high profile, you know, it's like it's sort of sea walls to prevent coastal surge, it's levees and so on, which are all clearly very important. But we also sort of reference this notion of adapted finance, which is about all the finance that's already flowing to infrastructure generally can be done in a way that is or is not adapted. So you might not think of it as adaptation finance if you're building, you know, a bridge or a toll road or an apartment block, but if you bring to that specifications and designs that are actually mindful of where the climate will go in 10, 20, 30 years' time, that really is a form of adaptation finance as well. So I think that's really important. And I was actually at a forum yesterday with a number of insurers and insurance regulators, and one of the points that they made is that when you're thinking about those sorts of things, it's actually really useful to bring the insurers into the conversation very early on, not after you started to build the project, but you know, in the design and conceptual phase, because they've got really sort of useful insights into say, well, what will make something resilient? And that's kind of a useful segue into a response that we're seeing in Australia that APRA is involved with alongside a number of other public and private sector groups, which is really thinking about that issue of the protection gap, the insurance protection gap. And you can think of insurance premiums as a price signal of the risk, but it's not always easy as a householder to respond to that price signal because you don't know what it is that's going to make your house more insurable. So an initiative that was set up a couple of years, just under 2 years ago in Australia is called the Hazard Insurance Partnership, which brings together our National Emergency Management Agency, which has got a certain amount of annual funding to invest in resilience, but also basically collaborating with the insurance sector. So it's got the Insurance Council of Australia, which is the peak body, and it's got a number of agencies, including ourselves, that are participants in that panel bringing expertise and insights. And part of the goal of that organisation is to really sort of try and lean into collective solutions, because I think no one group, organisation or sector can solve it by themselves. And the sorts of things that they're trying to do is they're saying, well, let's try and ensure that at least some of the funding that is coming from the public sector is actually going to put downward pressure on insurance premiums. And there are some very good reasons to invest in some things that won't have any impact at all. So a good example of that is you've got a high flood risk area and there's funding to build some evacuation shelters on high ground. Now that's obviously really useful, will save lives in the event of a flood, but won't have any impact on insurance premiums because the houses are still underwater. But there will be other things, which might be community level solutions, that will have that impact. But one of the other things that group is working on is what they call a sort of mitigation measures database. And unfortunately, in this context, it's more like adaptation than mitigation, but anyway, which is basically saying what are the sorts of measures you as a householder can take to harden your home against fire, against flood, whatever it might be, and which are the ones that will or won't be likely to have an impact on your premium. So I think just a lot of this is about getting the information, the insights, so that communities and individuals can respond to that risk. But I think a really crucial lesson for me is that it's about multi-stakeholder work. And when we publish the note, you'll find at the end there's some national perspectives. We've got about half a dozen different jurisdictions where they sort of shared the perspectives. And the one that really struck home for me and kind of surprised me in a lot of ways, given that the NGFS we've been thinking about adaptation for probably the last couple of years, was the case study from the Bank of Greece, because they actually started collaborating with other agencies on climate change and thinking about adaptation in 2009, so 15 years ago. And they've really made some quite interesting progress, really coming from that perspective of bringing multi-stakeholder collaboration together.
Thank you, and I think Iran, it's just a good segue to you, right? You're at the Australian version. Can we have the European one?
Thanks. Well, I think I very much agree with what Sean said. But if I think about what is the role of central banks and supervisors in this, I think Sean pointed like if we don't adapt, we'll see more inflation. So we need to know where the effects are coming from. We are already seeing the impact of food price inflation from droughts reflected in food price inflation. So there's a real need to better know it and to look into it and signal the need to of the impact of climate change will hopefully provide incentives for governments or anyone out there to take adaptive measures. And that's, I think, the same for how we supervise banks. We want them to manage risk. Well, if they know where the risks sit, if they know where their collateral sits, hopefully they will provide incentives and they talk to their clients, their customers, to also make adaptation measures. And what I really like what Sean said, the money that goes into infrastructure, and you just think about, okay, but is it resilient to deal with climate change? What is coming, to have this awareness in every decision you make. We want it for mitigation. I think we're getting there slowly and slowly. To every financial decision you make or investment you do, you think, okay, what is my CO2 exposure? But now we also have to think, what is the physical risk and how I can shield myself and build my resilience. And one big solution I still see, and that talks to the point that Sean made on collaboration, here to work with weather agencies on data or other institutions to really know what's happening, and also the point on local. Because also we looked into what are the risks of real estate in certain areas. It's not the postal code you have, because that's often the level you have of data of your collateral. It's not even the street. Sometimes it's what kind of building are you living in? Where is it really sit? And to work with local communities to work toward this adaptation, I think this is really, really important. And the last point I want to make is also really look, what are nature-based solutions to have adaptation here? Nature is degrading heavily. It needs to be protected, but it's also offering big ways to shield ourselves and also make adaptation there. So I want to also bring in the nature part. Thank you.
Well, if I can make just a side comments, but from someone working on the field for a long time, hearing central banks talking about nature-based solutions, I mean, 20 years ago that would have been quite a shock in the system. So it's really interesting. One thing maybe, because you mentioned inflation, and I was about to mention that we haven't said the word so far. One of the things that we had been looking at is the reaction of monetary policies to big disasters, where you have at the same time a supply shock and sometimes inflation, but also investment needs to repair. So tightening monetary policy is also making it more complicated. Is that something you're looking into?
Yes, so we're looking into, well, it's a supply side shock, right? And we've been looking into, and there was a big, if you want to know more about this, because there was a great conference last Saturday from the Green Swan, it's part of the NGFS. There was a full panel on this with Christine Lagarde, the governor of the Bank of Spain, Banque de France, and I'm forgetting one, but they actually talked through this and what can you do as a central bank on, do you have to look through or do you already have to deal with a bit or higher inflationary times to have more investment going to adaptation or mitigation, both of them. Well, therefore, the 2% target that we have at the ECB, it's still anchored and it served us well. And also to have a steady inflation or not too much inflation also helps in investment flow. So that's our standpoint at the moment.
Okay. Thank you. Sorry, I couldn't resist asking the question. Eric, I'll get back to you. And so I'm working with the World Bank, and we have a lot of clients that don't have the level of data and sophistication that you have in high-income countries. So I was curious about the recommendation that the Adaptation Gap report was giving to central bank and supervisors, but maybe also a little focus on the lower-income countries where if you don't have financial inclusion, it's very difficult to put insurance as the solution, right?
Yeah, yeah. No, a couple of points. I mean, one thing, in 2015, when central banks started to engage, it was transition risks. It was the most obvious. It was easiest to start doing stress testing around. Now, of course, and as you start to get more information, data on the physical climate risk side, then you're starting to raise expectations there and integrate into stress testing, which I think is very important. The banks have been working to try to fulfill those asks. But of course, as we go into emerging market and developing countries, the needs get higher and the data more patchy. So definitely there's more work to be done. A couple other points, Sean, you talk about new stakeholder arrangements. Actually today, talk about insurance, a new formulation called the Forum for Insurance Transition to Net Zero, FIT for short. They will actually issue, so it's actually an interesting coming together because it's actually market actors, insurers, reinsurers, with insurance regulators. I think it's an interesting example in a voluntary realm, how you can get both pieces in the room to actually work. And actually today they will issue their first guidance, which is on transition planning for insurance underwriting. So it kind of shows that as we get started, we need to get different actors together to figure out how to start to get the ideas on paper, but also to sort of build the momentum around certain concepts. Of course, eventually, once you start to apply that guidance, market actors have a different role to play to the regulators, but at least you can initially start to say, well, how should we go about this? I wanted to come to Jill. You mentioned a point around the NCQG expectations. We don't know if we're going to get a positive outcome in the next 2 weeks there, but we have to differentiate that there's an element around the quantum. So what is the big number going to be? There are some big numbers being bandied around, and we don't know whether it's going to land. But very important, I think there's the qualitative aspects of that goal. And exactly what you mentioned, what we would like to see, and actually we're issuing a paper today on NCQG expectations in terms of what could be done to maximize the ability to mobilize the private sector. And one of the issues is raised is that the idea of climate finance is traditionally the idea of public funding going to help build stuff on the ground, sort of blended finance or ways on a specific asset level. And one of the calls in what we and others are putting forward is that we need to get a better understanding around a notion of what we call transformational finance. Because it's the idea of all the things we're talking about today. When you go into EMDCs, there's a lot of work that needs to be done. And there's often a lack of resources to do it. So it's putting in place the infrastructure, the systems infrastructure, the governance, the capacities within government, also within all stakeholders to actually be able to do this stuff. And part of the call is to say, if we really want to mobilize the private sector, you need to be putting capital in that area to create the enabling environments. And then the assets will go forward, some which might need blending, some which might not. But if we don't have the system infrastructure in place, very little is going to get done.
Thank you so much, and I think it really speaks to us when we discuss the role of development and economic growth, that the NCQG is really important, but it cannot be disconnected from the bigger picture of development aids in general and the financial sector in general. So thanks for making that point. So Jill, maybe you will want to answer to this, but also you promised us 2 solutions. So
they totally align with what everybody said. So yeah, look, let me start on the kind of product side of things. So totally agree. We need partnerships to operate in different ways. We need public sector money. I think there's lots of examples. We did some modelling in the UK housing stock in terms of risk against wildfires, storms, floods, any major physical events. And our team did the work. And exactly to your point, they could then sort of pinpoint. And it wasn't based on construction of building, but it was based on location. And I said to them, well, what are you going to do with that data? Because does that then mean all these people can't get mortgages? So in some respects, once you find out information, I think we then got to work out, well, how do we fix it? And the only way to fix something like that would obviously be a combination of a collective insurance fund and then insurance and banks working together. So it's a sort of new way of looking at the problem and trying to fix it. So I think, there is a load of innovation going on globally. We've mentioned some of it. In terms of, and I know these guys will know all about it, but parametric insurance, for example, when the insurer pays out if an event happens, and I came across a case of a coral reef. So the sea warms by X%, and when that temperature is reached, the insurance company immediately pay out. So, and that is particularly for protection of a coral reef. So it's a nice, I think, nature-based solution using public-private finance to help preserve what we've already got. And then you have the case in India with the workers who, if the temperature gets to 40 degrees, their insurance then pays them to stay at home, because clearly to be working in the fields all day at 40 degrees is really detrimental to their health. So I think parametric insurance is great. I think collective vehicles are really good. And then another example I have, and sorry, I know there are loads of asset management and banking examples. I just happen to have 3 insurance ones. The other one that I have is Build Back Better. So at the moment, typically insurers pay like for like. But I do think, to your point around what is resilience, what is adaptation, and that kind of definition, if you have an insurance policy that when your property or whatever it is ruined by some physical event, then you can build it in a, let's say, more earthquake resilient fashion, or more hurricane or cyclone resilient fashion. So it's a different type of product. But what I would say is, I think there's still a lot of work to be done. And I think the discussion and the fact that we have so many on the panel today who want to engage and consult and be with financial services in the private sector is brilliant, because it's complicated. We are going to need new regulations. And on the sort of, thinking, putting a few things out there in terms of questions, then financial services would say, well, and you guys will go, oh yeah. They'll say, well, we get capital levies for project finance. We get capital levies for long-term loans and for debt financing over equity. And these are all things that climate finance needs. So, I think we need to look at what legislation and what regulation helps, but also, is there a little bit of change that needs to happen in order to enable some of these flows to go more freely? And then my second and final point, and I will then shut up, is around the stress testing and scenario modelling. And I'm sure FS will hate me for saying this, but I think that has been hugely powerful in getting the financial services sector to really focus on climate change as a material risk within their business. I think it has been quite catalytic. I guess I have a question, and you raised this great point of, are we actually doing enough? Are we thinking through all of those implications? Are the scenarios painful enough? Are we doing enough, testing to destruction type of thing? But I think that has been hugely positive.
Thank you so much. And so this is a short session, so we don't have a lot of time, and they will stay after the session if you have more questions. But maybe I can offer the opportunity in the room for at least one question. Yep, it was first. I'm sorry. So you can just join me here. It will be easier.
We can share.
I got a microphone. Yeah, that's better. G'day, my name's Donovan. I work heavily in the finance sector. The bit, I think Irene touched on it somewhat. I'm not so much worried about the bricks and mortar. I think we'll get around that. It's the limits to adaptation. So if you're in Te Puke and you rely heavily on kiwi fruit and we get to 2 degrees and the system collapses and we have no kiwi fruit, then what happens? Or there's no forestry in Australia because of a systems tip. How is this central banks, because it's such an important role, going to navigate that part of non-bricks and mortar type of climate risk? Thank you.
Thank you. And I will give each of you the opportunity to make a very small, in the last 5 minutes before we turn to the conclusion, concluding statements, including answering the question. On my side, the points I would like you to maybe say a little bit more is on how countries at different levels of development might focus on very different solutions, and how the kind of solutions. So NGFS has now, it started with a lot of high-income countries, but I think it has expanded its membership quite a lot to countries at lower income level. So how do you see answering the different needs of countries some with very sophisticated financial sectors, some with most people even unbanked. So how do you see things differently for those different countries? So maybe we'll just start with you, Eric, and we'll just go and we'll let you, Sean,
I can start, very quickly on this point. Jill mentioned parametric insurance, which these are new products. Often the challenge is employing a new product in a market. What's the distribution channel? Particularly, what's the last mile? How do you get insurance to farmers in a market where that hasn't been the case? Interestingly, actually, banks are the ones who often have the relationship. So we see the opportunity for banks to be working with insurers, to be placing such cover. There are challenges typically with insurance products, but because there's a culture view of are they going to pay out, and there's a real work to be done to raise awareness, and often it's a long-term process, market development, which is expensive. And so once again, coming back to the climate finance concept, that there definitely is a social value to help develop these markets, work with the private sector, work with insurers and banks, but take on a more social mandate to actually try to help them develop the market so that it becomes financially viable in a way that's actually useful for the farmers or for the communities.
Thank you. Please.
Thank you. Great question, because the question is, what is the world that we're adapting to? And can we adapt in certain regions? And this is the topic that's been on our mind at the European Central Bank, and a topic that we just need to think through. Are we still building or reconstructing houses in certain areas? Will there be desertification in the south of Europe? So we need to work really closely with climate scientists, like where this will be going, incorporate that in our climate scenarios and think about it. And it relates a bit to the point of the last question. Governments still have the best tools in hand to show where we're going. And I think one of the key points that on the global versus local, to have governments lay out, identify their risks in their countries, lay out where the adaptation investments are needed, then it can help also to channel money from the private sector and the people themselves to adapt more. So I think this is, and even government to translate that into really the local communities and have action created there.
Thank you. Jill?
Oh, I am on. So one of my pet topics is the language that we use, and I think you both picked up on that. I do think at a country, business and citizen level, we're not necessarily engaging in the way that we need to. We're not using the words that we need to. I think one point, if you did a survey of citizens globally and asked them about what does 1.5 mean, I'm not sure who would know about that. They know about how their lives are impacted, and they know about how their livelihoods are impacted. And I think building on the both of my other panelists' point, I think a critical role here is not just for central banks, but for everyone participating in COP. How do we make the language of climate change and what's happening much more engaging and understandable, and how do we make that feel real to businesses and to citizens?
Thank you. Sean?
So look, it's a really hard question, and so if we're going to get one question, I suppose it's good to get a hard one. I mean, if I think about the way we framed the adaptation need in the concept note, we did cast it very broad, in that the physical risks that are associated with climate change span from the acute to the chronic. I think it's fair to say, though, in terms of a lot of what we focused on in that note, and a lot of what we've talked about even today, is more on those acute risks, so the sort of disaster type risks, which are really important because the impact is huge. But there's a sense in which, hard though they are, it's almost easier to grapple with, because we're kind of doing it already with insurance. We're facing those disasters already, and it's about saying, well, how do we respond if the frequency and severity ratchets up? And it's hard, and protection gaps are growing, but it's grappling with a known problem, where some of the chronic risks, we can shift from something where what was normal in terms of crops or something, it just don't become viable. And so I think that's a really sort of interesting challenge. And I'll probably go here in a direction that a prudential regulator doesn't normally go, which is I think this also points to some of the opportunities as well as the risks. As you think about the changing environment, to say, well, okay, maybe there are certain crops and so on that will no longer be viable, in 10 years' time, but maybe there'll be others that aren't now that will be. And I saw a chart a little while ago, I think it might have been in The Economist, that was sort of mapping out where all the ideal wine-growing regions in Europe will be in 30 years' time that aren't where they are today. So I think that's a really useful lens to bring when you think about those chronic risks, where it has the potential to be a really different type of shift than the response to the chronic events. But I don't have a great answer because it is a hard question. So thank you.
Thank you so much. So in the agenda, I was supposed to summarize the key takeaways. I will not try to do that. I just want to leave you with one key worry that we have from a World Bank perspective. And we had a big investor visiting us a few months ago, showing us some data work to identify risks to take into account into investment strategies. And it was all based on exposure. And so we saw this beautiful map of Vietnam, all red. And to us, the message was, are we telling investors, don't invest in Vietnam just because the risks are high? And if you look at the map, it's all of the places that are most in needs of more investments were in red. And so I think to us, one of the key questions when we're looking at this risk management and the regulation of banks is how do we make sure we're not creating one more obstacle for those poor places to access financing and private finance especially. And when we have tools that are a little bit crude because we're starting and nothing can be perfect the first time, the risk is that we're creating those effects of making it just more difficult. So I think this is something we should really keep in mind. But now we'll turn to, first, join me in thanking our panel. Thank you very much for all of those points, and I think it really fit well together. So thanks a lot for that. To close this session, we're very lucky to have Sabine Moderator. So you're the chair of NGFS, so best place to discuss those issues, and also you're a member of the executive board of the Dutch Bundesbank. So please join me here for the closing remarks. Thank you very much.
Yeah, thank you very much. And dear friends and dear colleagues, it's really a great pleasure to be here. And I have been listening to the panel discussion with really great interest, and I think so you raise quite some issues. There's one aspect that strikes me, and namely that at this point there's no way back, and adaptation means moving ahead. And we gather here today as a number of severe weather events continues to rise, fueled by climate change. And the widespread flooding, even just here in Baku, hit last month, is clearly one example. So far, the devastating floods, that claimed over 200 lives in the Spanish region of Valencia, end of October, not so far from here. And it was one of the worst natural disasters in Spain and Spain's modern history. And it's clear that we urgently need to bolster our defense against severe weather events. Yet, climate adaptation measures remain insufficient in both global south and global north. So, what I would like to address today is what are the key takeaways of today's session, but also in general, we take out of the work of the NGFS. So let me mention three major points. First, the global climate adaptation efforts need to accelerate. The World Bank estimates that a mere of 5% of global climate finance is allocated to adaptation, just 5%. And that means that out of a total of $1.4 trillion allocated to climate finance in 2021, less than just $100 billion went into climate adaptation. And only a fraction of this already small sum reaches emerging and developing economies, and I think some of you mentioned that. So, frankly, I think we ought to do better. The second point in this regard I would like to mention is more private funds need to go into adaptation, and that's the reason why we also set at the NGFS up a work group that deals with that. UNEP, so the United Nations Environment Programme, estimates that the adaptation finance needs of developing countries are around 14 times the current size of international public adaptation finance flows. So we need 14 times more money than we currently see. So therefore the gap will not be met by public funds alone. The financial sector, the private sector, needs to play a role too, and I think a big role. The third point I would like to mention is we need to tackle existing barriers to adaptation finance, starting with the lack of awareness among some stakeholders. Other hurdles include underdeveloped capital markets in many countries that are most affected, and the fact that adaptation investments often serve a common good. And these factors make it challenging to generate enough private capital for adaptation measures. And last but not least, we need to get better at touting the benefits of climate adaptation. And what are exactly these benefits? And I think this is really important, that we understand the benefits of adaptation finance. And let me also here briefly mention 3 benefits of adaptation finance. First, by reducing climate damages, the financial burden on governments and the private sector is alleviated. The second benefit of adaptation finance is reduced climate damages and lower insurance costs yield notably benefits for the economy and beyond. And the World Bank estimates that every single US dollar spent on adaptation returns $4 in overall socio-economic benefits, and more recent studies point out to an even greater cost-benefit ratio, maybe even to 1 to 12 US dollars. The third point I would like to mention is non-market social and environmental benefits will accrue over time. And let me just make one example. Preserving wetlands and coastal mangroves bolster resilience. And this is particularly important to low-income countries and disadvantaged groups, also including women. This triad of benefits is often referred to as a triple dividend. And what matters now is translating this promising payoffs into larger investment in climate adaptation. And before I conclude, I would like to briefly discuss the role of the NGFS, so our network of greening the financial system, in this regard. So I think you heard what the NGFS is about. So we are a coalition of now 140 central banks and supervisory agencies. And what our goal is to better understand climate risk and nature-related risk, to address this risk, and finally also to mitigate this risk. And it is our responsibility and duty to raise the awareness about the significant risk towards the economy and to the financial system. Because I think raising awareness also to the financial sector, but also to the corporates, is essential. A lack of preparedness for severe weather events is such a risk. And the Network for Greening the Financial System is now the organization of 140 central banks and supervisory agencies. I think we have a clear role here to play. And so I'm encouraging you all to take a look at our just new conceptual note on adaptation. I think, Jean, it will be published today? It is already. Oh, good. So you can have a look here and really please read it. This is our first try on get a little bit of grip on adaptation, because I think there is really a lack on research on adaptation, and we really, so Jean and Shelagh, the two of you will really, within the next year, try to have a closer look at that, and I'm really looking forward to have that. So our aim is actually to launch a comprehensive report on adaptation at the COP30 in Brazil. So it's just a year from now. So Jean, Shelagh, great luck. And I really would like to encourage all of you, not only listening here, but also maybe virtually, please help us to set up this report, because we would like to have an integrative report, central banks, supervisory agency, financial sector, but also corporate and the society. So please help us in setting up this report. Obviously, all this would not be possible without your extraordinary work, Sean. So I would also like to take the opportunity to thank you, Sean, Carmody, but also Shelagh Kahonda from the National Bank of Rwanda. So maybe please join me in applauding the two of you. And encourage the two of you and all of you that want to get involved to really align forces within the next year to set up a great report. Yeah, so I would like to conclude the session by quoting, and I know that Shelagh has also used this lovely quote by Charles Darwin, but you know what? I think this quote is so important that you need to know it by heart, and therefore I repeat it once again for you. So what Darwin said, and I think is true more than ever today, is he said, "It is not the most intellectual of the species that survive. It is not the strongest that survives, but the species that survives is the one that is able to best adapt and adjust to the changing environment in which it finds itself." So I think there's nothing to add to this, and thank you so much for listening.